maybe we should be actually valuing these businesses differently.
It was a lavish party for a few years, produced by...
Do the founders make actually any money?
Yeah, I mean, $3 to $5 million. I could get to $1 million in revenue and be barriers to entry continue to get lower. Any successful brand is going to have 10 copycats in the next year.
How do you think about
To start an e-commerce business? Well, the real answer, hopefully never.
Hello, I'm your host, Mike Gelb, and this is the Consumer VC podcast brought to you by Propeller Industries, the leading strategic finance and accounting partner for venture stage companies. On this show, we discuss the intersection of venture capital and consumer innovation. And if you're enjoying the show, please subscribe on YouTube or whichever platform you're viewing this content. If you want the full experience, subscribe to my newsletter at theconsumervc.com, where I send fundraising updates and you'll receive new episodes straight to your inbox and a weekly recap of all the consumer deals that are happening. All content and episodes are for informational and entertainment purposes only. It is not investment advice. Our guest today is Fan Bai, who's the founder and CEO of Hedgehog. Hedgehog buys $3 million to $15 million revenue brands that have been built over 5+ years and are not yet profitable, and typically VC-backed. Some of the brands include Rockets of Awesome, Felix Gray, The Reset, and Baboon to the Moon. Fan also founded Blank Label, which is a formal men's apparel brand. We discussed his introduction to entrepreneurship and what he thought was compelling about men's fashion and starting a men's fashion brand, what multiples were used for early digitally native brands and how that's evolved and changed, why he started Hedgehog, and the types of opportunities he saw when he was seeing the change in how brands were being perceived by venture capital. And we also talk about margin, EBITDA, is this a period of growth, how he's thinking about this current period of time when it comes to his own brands, what are some of the white spaces he's looking at, and as well as categories he's finding attractive when he thinks about buying brands, and much, much, much more. This was a wonderful conversation. Thank you so much, Fan, for coming on. Without further ado, here's Fan. Fan, thank you so much for joining me here today. How are you?
I'm doing great, Mike. Excited to be here. Long-time listener, first-time caller.
Thank you. Thanks so much for listening. I know that this has kind of been on both of our agendas to do this for some time now. And really excited that we finally got time here today. This is great.
Yeah, no, likewise. It's been a very dynamic, busy year for all in consumer. So, but yeah, excited to be here today.
Yeah, this is a really interesting kind of point in the market for a consumer. But before we kind of get into that, I want to talk a little bit about men's fashion and your kind of first foray into building brands and kind of specifically focusing on men's fashion, which of course starting Blank Label more than 10 years ago. Why? Talk to me a little bit about how that came about and why you also picked that category to initially.
Yeah, sure. It's when I started Blank Label, I wanted to be Andy Dunn. I was like, here's a great looking, well-educated, beautiful head of hair, starting a business in a category that I could be a customer of. What a great role model. And I still think that today, by the way. But yeah, in terms of men's fashion, it was just like, it was a pain point that, I could understand myself, had a custom men's clothing business. I bought custom clothes. We wanted to make it more accessible with the internet. Instead of this, what traditionally was a more stodgy, had to go to a men's shop, kind of felt intimidating. That was our first business. And what Andy and Bonobos had also shown was that you could build a business with large enterprise value and specifically get a software-like or technology-like revenue multiple. And I thought, this sounds great. I could get to $1 million in revenue and be worth $3 to $5 million. From tier one VCs, from the smartest people in the world. And I think, we can take this all the way to the end, which is like, I was one of 1,000 or 10,000 or maybe a million ships that got set sail. I think Bonobos was founded in 2007, 2008. And for the following 5, 10, maybe 15 years, this idea that you could be a smart person with a relatively easy, which isn't to downplay Bonobo's product, but not, it's definitely not rocket science, and it's not heavy IP. A smart person could launch a product, raise money from the smartest people in the world at revenue multiples, and experience a 9-figure outcome, which Bonobo successfully did. Over 3 times revenue to Walmart, losing tens of millions of dollars a year. And what an incredible and inspiring story. That was the path that I thought I was on, that I could build this men's clothing business, something that I could be a customer of myself, and I would be able to exit for a revenue multiple. And we can get to the chase and tell you that ultimately that didn't happen.
Well, when did you kind of feel, and I think when VCs, I think I want to say, and we talk about this a lot, but when kind of VCs were underwriting, as you said, in the kind of the early 2010s, late 2000s, maybe like mid 2010s as well, that they were kind of viewing these types of businesses, like the D2C brand business, meaning like that was like the original channel, as software businesses. Even though it wasn't software businesses, these are ultimately inventory based businesses, right? And should be valued like inventory based businesses. It's just a new channel. But I think we got caught up with like the distribution and like the thinking that the distribution was a thing, when it's like, okay, these are still product led businesses. These aren't, software businesses. When in your mind did it kind of switch for you from like that? Because it seemed like from the beginning, like seeing what Bonobos had done and seeing that, maybe other brands as well were kind of being thought of as like software businesses, and kind of being also invested from like very tech heavy or software focused, VCs. When did that kind of shift for you, and you kind of start feeling that kind of shift, that wait, this is actually not, maybe we should be actually valuing these businesses differently?
Yeah, look, I understand why in the early generations, so let's call it between 2010 and 2015, there was all this capitalization into direct-to-consumer e-commerce businesses. Because if you scrubbed out the names and you said, hey, here's something that feels infinitely scalable, that has 75 to 80% gross margins, and can get to $100 million in revenue within 3 to 5 years, I could equally be talking about a software business or an e-commerce business. And ultimately, like, the nuance is what makes those two things really, really different. But all of those kind of facts could still be true. But it's all the nuance that kind of and the complexity that beyond that makes it not work. To answer your question, it's like so we never reached the scale. We never kind of broke out, got to scale. And after several years, we kind of looked at trying to exit. And when we first went out to market to try to exit, I thought, okay, so here we are, like several $1 million in revenue. Yeah, cool. I'll take my 3x off the shelf. Thank you very much. Yeah, you'll pay $20 million. Yeah, I was just waiting. Like, and then people were like, what are you talking about? Like, and I was like, well, I just want my Bonobos exit, my 3x revenue. And like, it doesn't, like young blood doesn't work like that. And that's when I was like, oh shoot. So how does it actually work? And again, in our corner of the ecosystem, in the small to lower mid market, so let's call it in the like $5 to $30 million revenue range, in the like 0 to $4 or $5 million EBITDA range, like the default is an EBITDA multiple. That there really isn't revenue multiples in the lower, small, and today even in the mid market. And so then we have to go, oh shoot, like how do we produce enough EBITDA that we can actually get an EBITDA multiple. Because at the time we were kind of EBITDA neutral, and that's when you go from playing checkers to playing chess. You're playing checkers when you're just focused on net revenue and growing net revenue. You're playing chess when you're saying, oh shoot, it's not just one line item on my P&L that I need to be paying attention to. It's all 40 line items: storage fees, credit card processing fees, delivery costs, returns, cost of running all your channels, each G&A line item. And you're like, okay, now I need to bump all of these things a couple of points to be getting a 10 to 20% EBITDA margin, to be getting a 3 to 6x EBITDA multiple. So yeah, it was a very sad realization when I went from a revenue multiple world to which is really just a fantasy in my head, to an EBITDA multiple world.
And like the EBITDA multiple world, playing chess, as you say, versus checkers. I mean, this was also kind of like traditionally, because it's not like, M&A for consumer brands. It's not like this is a new thing, right? In the past 20 years, it magically happened. Like this was the traditional model. It's just that because D2C brands were kind of thought of software, it was kind of we only really thought of it as from like a revenue standpoint. Like that was kind of like the marker that you kind of aim for, right? But of course, from like a gross margin perspective, pretty different overall. Unless maybe you're unless you're like beauty and personal care, which maybe looks actually similar. But for the most part, pretty different from a gross margin perspective. And I think that too, and so like it's not like it was like a new thing going to like the EBITDA thing about EBITDA. It's just that for like D2C brands, it was like, oh wait, we are actually maybe closer, even though it's a different model in that we're actually selling a lot more majority direct rather than wholesale. But we actually look a lot more like in terms of how our in terms of value, it's a bit more like a wholesale business rather than like a D2C business.
Yeah, no, that's exactly right, Mike. It was there was a lavish party for a few years, introduced by some very nice investors. They only had the finest champagne, and everyone got very drunk. But yeah, you're exactly right. I think that, and we're maybe at the tail end of coming to that realization that it is very much like it was before. But yeah, during this period where there was all this investment that went in and pricing these startups on revenue multiples, everyone just shifted to, oh, that's going to be the way that the world works. And I'm going to be able to get my revenue multiple on the exit. And I think it's important to distinguish, like, it's one thing having a valuation of a revenue multiple from an early stage investor, and it's a whole different thing having an exit on a revenue multiple, or having an exit valuation. And the large driving part of that is like early stage investing comes with a bunch of securities, governance, and terms, and probably the most important one being liquidation preference, and that they might be investing at a 2 to 3x revenue multiple in terms of ownership, but they'll also get the downside protection of they might get 1 to 3 times their money out first before anyone else gets paid. And that allows to inflate the valuation a little bit because they get the downside protection. But that is not, it's almost apples to oranges versus what your actual exit valuation will be.
Yeah, and I think I mean that's a great point. And I think too, I think sometimes if you're a founder, you might get excited that, okay, hey, we got maybe less dilution, or we raise, we're when we think about what to negotiate on the term sheet, oh, we're going to negotiate and have our valuation be sky high, right? But really, like that's not, it might not be reality. To your point, when you actually do exit, it might be lower than that. It might be roughly that, and maybe you've actually achieved a lot more success when it comes to revenue, and maybe even EBITDA. But at the same time, you might not get as much money or not nearly as much because of what the actual preferences. And if also they have preferred stock or like what have you, like there's a lot of other parts to actually negotiate from there. It's not you shouldn't only be looking at obviously what like the valuation is, but also like what the actual liquidation preferences as well. So that's a great point.
Yeah, no, I was just going to reiterate that I think that um, in today's market where there's been a lot of compression in pricing, people are paying more attention to the liquidation preference that they had that they probably glossed over more than ever before.
So when you first started Hedgehog, was obviously you already had your own brand with Blank Label, but how are you able to maybe raise the first round of funding, or at what point did you have to, or were you kind of self funding as well through your business when it came to acquiring additional additional brands?
Yeah, we raised money pretty early on in Hedgehog's life. As you said, we already had a couple of brands in the portfolio, so there was something there already. And then ultimately, our investors believed in the strategy that we could go and acquire more brands, produce EBITDA from turning those brands around, um, and grow this platform. We've raised money a couple of times, a couple of times on equity, a couple of times on credit, and but yeah, we're capitalized pretty early on in the Hedgehog journey.
And and in terms of like targeting, brands, I know that your website, and I think we talked a bit about more, talked previously about this, and also I've heard you talk about this on other podcasts. But this kind of messy middle where maybe it's the company's venture backed, it's understood that it's not really going to receive like venture type returns. But can you talk to me a little bit about the actual what how you identify what quality brands are in terms of what the actual range is?
I'll comment on that question in two different ways. So I think that there's two components to it. One, which is, yeah, I think the messy middle is really, really tough. If you've raised money, which almost certainly means you have liquidation preference, um, and coupled with almost every brand that we see has some credit profile, just the proliferation of credit in the last couple of years. So you've got the way the capital stack sits, you've got the lender who's the most senior, you've got the preferred, and then you've got the founders or common below that. And the way that prices compress so much, it's questionable as to who gets value. Like obviously, again, the lender being first, and so that becomes a really tough space. We have a lot of founders that are working on their businesses for often several years that are now all of a sudden saying like, I might be out of the money here. I could get an exit, but the exit, just the way the prices are working, are happening at a point that like I don't see anything from this, and we're seeing that a lot, and that's a really tough spot to be in. In terms of like what we look for in a quality business, or what we think is a quality business, I think there are a few major components. One, which is gross margin profile at the top of the P&L. Like it's actually, I'll start even beyond above that, which is like revenue quality. Like, is there anything sticky about the revenue? I mean, that's the great thing about software businesses, and why software businesses are at a revenue multiple and at a 10x revenue multiple is because it's revenue quality is really, really, really high. Like it's like a great software business, their revenue is like an investment grade bond. Like people aren't churning from that. You are going to get paid. For a consumer discretionary e-commerce business, really volatile. So like, is there any revenue quality? Is that through subscription, repeat? Beyond that, we're looking at like product margin, and then like less cost of delivery. So what we think about as true gross margin, like we really need true gross margin, again, net of cost of delivery, to be north of 50 points. That probably means that you've got product margins landed of north of 70 points. And most businesses we see, and we've seen hundreds of P&Ls, do not have that. They started, because a part of the original D2C promise was you'd go direct to consumer and you'd cut out the middleman and you'd kind of target 50% product margins. The problem is that 50% landed product margins actually gets you around 30%, maybe even 25% gross margins when you include credit card processing fees, returns, receiving costs, freight costs, storage, and a 25% gross margin business is almost impossible to make work in e-commerce. So gross margins is really important. And then it's kind of operational complexity. We see a lot of subscale businesses that are running lots of channels. And I know that omni-channel is the buzzword of 2022, 23, probably the buzzword of 24 in e-commerce. We actually think that that's really risky. And we actually, like the more channels for us in often case, the worse the acquisition opportunity is, because that just requires a lot of brain power, a lot of heads, and a lot of marketing support to run. We see $5 million revenue businesses that are on their .com, running Amazon, running marketplace, running retail, running international, and it's that gets very expensive. All else being equal, would much rather that business doing the same velocity just in .com, and then leaving the others as upside once you've got more scale. So there's some of the attributes that we look for.
This episode is brought to you by Propeller Industries. If you run a high-growth business and you're focused on profitability, extending your runway, and improving your operational efficiency, you probably need a finance and accounting whiz that will grow with you. Well, instead of hiring someone full-time, what would be cost-effective is working with Propeller Industries. Propeller Industries is a leading strategic finance and accounting partner for venture stage companies and has partnered with over 1,000 startups and high-growth businesses across consumer products, consumer tech, and enterprise. Some of the brands that they've worked with are Liquid Death, Olipop, Hims, Farmer's Dog, Away, MoviePass, and Giphy. Propeller also provides specialized support for fundraising and M&A with transaction advisory services. Propeller's TA team of former investment bankers and investors can step in on more of a project basis when pursuing full-scale financing and M&A. There's a link to Propeller Industries in the show notes if you want to learn more information. In your mind, let's say D2C is a starting point for a business. When do you think it makes sense, roughly, that actually a D2C channel or a D2C brand should actually expand to additional sales channel?
Yeah, I mean, look, the real answer is hopefully never, because D2C is actually a great channel. If you can be ButcherBox and do 600 million D2C only, amazing. Or Athletic Green, sure, yeah. If you can do 9 figures only direct, it just makes your business much easier to run. I think you're going omni-channel sometimes because you really have to, sometimes because it's like what your product, like if you're in a low AOV product, if you're in a high shipping cost product, direct's probably not a good channel for you. If you're in like a one-time only purchase with no replen, like probably like retail might make more sense than .com. So yeah, I mean, I think like we still love e-commerce for all of the reasons that the original tech investors loved e-commerce, which is it in theory and in its best cases, it is incredibly scalable. But most products don't fit that. Most products you can need to open a second channel, build brand awareness. And I think that obviously it makes sense in a lot of categories where if you can get a partner like Target, where you're getting good sell-through and you're not necessarily making great margin on it, but it's developing brand awareness and you're getting replan at the .com from that, then yeah, again, I think it can make a lot of sense. I think it sets also a lot of brands up to stumble because, and we've experienced it ourselves. We have a lot of brands that have opened doors and you just don't get the sell through, and that can get tricky.
Well, let's touch on what you said about how the DC channel is scalable, and obviously this depends what scale means to different people in terms of from like a revenue standpoint. But um, I think a lot of brands are and a lot of kind of investors are kind of pushing for brands to go more omni-channel because, of course, you have this middleman and Meta, Google, and it's becoming a lot more expensive to actually achieve scale. So how? And I know that you're very bullish on the D2C channel that you can kind of reach scale. And of course, we've seen it with ButcherBox, we've seen it with Athletic Greens. There's some great examples of companies that reach scale. But how do you also think in terms of your brands and also when you're analyzing brands, how do you think about like online CAC overall?
Yeah. I think there are only it really needs to have good channel fit. And so it's not so much that we think that D2C is better than retail. That's not what I'm saying at all. It's more D2C is more expertise, and we look for products and brands that have better channel fit. So for us, like that's largely like the best part of D2C is replan. If you can acquire a customer and get them regularly coming back, whether that's through a subscription or it's a kind of seasonal replan, like that can be a beautiful business. And arguably like that's really the only kind of D2C business that can really work if you include the meta tax. If it's really expensive, if you're in a category where it's expensive to acquire a customer because it's hard to explain that you're a low AOV product with high shipping costs with no replan, that's a terrible D2C business. And but we've seen a lot of those, and so it's more like it's more about like kind of product channel fit. And again, our expertise happens to be more in .com.
So let's dive into that in terms of what the ideal product channel fit is for DC. Obviously, you've named off a few different attributes that actually make a very good, compelling DC brand. High AOV. You have to have higher than 50% gross margins. But where does that fall into specific categories for you that you then find attractive when it comes to that you're able to actually scale that are companies that are able to reach scale in your mind on D2C?
Yeah, I mean, I think return and replen or repeat orders, replenishment orders, it is really where the magic of D2C is. And so what are the categories we see that? This is no secret, but like supplements is obviously a great one. We happen to think that apparel, just because most apparel brands, you're buying multiple items, there's some kind of seasonality push, colorways, etc. I understand that a lot of people don't like apparel because of the high return rate, but we think the LTV tail makes up for more than makes up for it. But yeah, repeat rate is a really big driver of what we think can make a D2C business work.
How do you also analyze the actual product itself, and when it comes to like the IP or differentiation? Does that as much matter to you, or how do you kind of think about that aspect when it comes to building a brand, and as well as is it a right fit as well too for the D2C channel?
Yeah, look, I think that the age of launching a product that's just a skin on something from Alibaba is probably over. And today, product innovation, real product IP is really critical for anyone starting a brand. Because we're brand buyers, and again, our playbook and philosophy at Hedgehog is much more about, hey, let's turn a growth business that was losing money into a profitable business, small but mighty. It's like we've largely already de-risked when we're buying a $10 to $15 million revenue business. We've largely de-risked that there is market demand for it, and so with that scale, assuming that there is inherent in that demand that there is some IP. Of course, we do new product development on top of that, but if we were starting a brand today, that product differentiation hurdle would be very, very high. Because otherwise, I think it's any successful brand is going to have 10 copycats in the next year, and barriers to entry continue to get lower to start an e-commerce business. So, no, absolutely.
I know that you kind of, when we talked about the predicament that some of these founders are in that, hey, if my company isn't nearly as valuable as I thought it was, and also like the exit potential out there, I might not see a dime, because of course you have the debt, inventory financing, or marketing spend, or there's a lot of obviously providers out there for both. And of course you have maybe your VCs or angel investors that maybe have preferred liquidity preferences. When you acquire a company, since I'd imagine a lot of the companies that you acquire are venture backed. I know like a few of them are. Do the founders make actually any money from the acquisitions from when you acquired?
Yeah, great question. Look, it's we always try to get the founder something, and it's we've seen some really bad outcomes where founders have been running their brands for a decade, and they have personally guaranteed debt in the business, and not only are you ending with nothing, but you're ending a 10-year journey with a big liability. And those are kind of the really sad situations. We always try to get founders something, and it's it's a really, really compressed environment out there. Hard to get deals done. A lot of brands that are down from last year, from the year before. Really tough.
I know we talked about it a little bit, but like, what in your sense is the kind of market pulse today? I'd imagine that in terms of seeing opportunities, there's more opportunities than ever for like a Hedgehog in terms of the acquisition side. But if you can kind of if you kind of like share a little bit about how you think about like the market right now in the world of consumer, that'd be great.
Yeah, I think that look, consumer deals are obviously still happening from both an equity standpoint as well as an exit standpoint. It's I'd say that what we've noticed and kind of had gleaned from our investor friends and peers is you just need to be a 10 out of 10 brand to be kind of raising money. And that's maybe a little bit different to years in the past where you could have gotten away with being an 8 or a 9, 8 or 9 out of 10, maybe even a 7 out of 10. But there's just much more scrutiny across all your metrics. And so it's just much harder. Still happening, but much, much harder. And so if you're not a 10 out of 10 brand, you're in this, it's easy to get into this doom loop of, okay, we're not growing, so we should conserve cash. We should invest less in marketing, which means that we're going to grow even less. So that can be very tricky. But it just means that the bar is much higher. Now, also exits are obviously still happening. And online commerce is still growing. And there are still the standout outcomes where positive top line growth, positive EBITDA growth, And sometimes you also just catch lightning in a bottle, where there's just great product market fit, and still strategic transactions happening. But again, I think that we're not going to get it'll be a long time before we see the Dollar Shave Club, Bonobos exits of 3 to 5 times revenue multiples of EBITDA losing businesses. I think transactions today are much more, yeah, there's an implied revenue multiple, but there's also significant EBITDA growth, double, like 8 figures of EBITDA growing double digits year over year. And those are just incredible businesses that should have their kind of requisite premium.
Do you think that there's a lot of kind of chatter, and I like your kind of your example of, okay, maybe don't have as much capital on hand as we did because we can't, maybe we're not a 10 out of 10 brand, so we need to maybe cut marketing spend, and I guess the goal ultimately then in that kind of realm, if you're kind of not growing at a pace, you're kind of cutting spend, it's more like a destined to like become profitable. And there's of course a lot of chatter around profitability and trying to become profitable and what have you. But do you think that advice really is for the brands that aren't 10 out of 10? The brands that actually that aren't able to raise capital? Is that only advice for those brands, or is that advice as well for like the 10 out of 10 brands?
Yeah, I mean, I think if you start with the end in mind and realize that you're most likely going to be exiting for an EBITDA multiple, like just design your business around that. And it's still possible that someone will pay an irrational price if you're growing quickly. But I think really hard to plan around that, which is what I think most people do. Most people assume that someone's going to pay an irrational price. And but if you can be a profitable business that's growing, time is on your side, and you can afford to get lucky. You can afford for someone to come along and pay an irrational price. You can afford to have a tailwind where you have an amazing 18 to 24 months that will give you a really big exit premium because of your growth velocity. Hoping that you can continue to burn, continue to be capitalized, and ultimately find someone to pay you an irrational price, even though you're EBITDA neutral. I just don't think that will happen in the next year or two.
When you acquire a brand, how do you think about the pace of growth for the brand? What is the kind of right pace or benchmarks that you're kind of looking to achieve, and making sure that, hey, we're not like growing too fast and maybe spending too much at the same time, we're not kind of growing too slowly either?
We are not growing our brands. Not this year, not last year, probably not next year. And that's as much a reflection on our strategy as it is on market conditions. Growth is just really hard, really expensive. We're seeing a lot of softness in consumer discretionary. And it's really expensive and hard to make top of the funnel investments, which you ultimately need to do to be growing the business. And that's also kind of as much a market condition, it's a strategy decision for us. We care much more about driving EBITDA and running a lean business than taking that money and and redeploying top line. So yeah, currently, and what has been for the last kind of 12 to 18 months, we're kind of we're budgeting to be neutral, and it probably will be that way for the foreseeable future.
What's the goal? I know when we started this conversation, we talked about, how brands were so focused on revenue. And now, of course, we're thinking about, gross margin profile. And obviously that leads to EBITDA. From revenue, what's the ideal metric when it comes to or percentage when it comes to EBITDA that it's actually churning out EBITDA? Is it like 10% EBITDA, or like what it is based off of a revenue in an ideal world?
Yeah, for us, like we want our brands to be like base case is 10% EBITDA profitable. 20% is the 20% is the stretch case. Most of our brands fit somewhere in between that.
Okay, got it. Got it. And talk to me a little bit too around what after you acquire a brand, how do you think about like the management team when it comes to when it comes to the brand and actually integrating them with the other portfolio? I understand that okay, we're gonna kind of there's maybe synergies across 4 or 5 of them, where maybe have maybe 1 or 2 email marketers instead of having one for each brand. But how do you think about bringing that brand kind of into the fold?
To be clear, Hedgehog's buy side thesis is very much brands that are in special situations, or in turnaround situations, which largely translates to like it hasn't totally gone well. And most of the time, when a founder has worked on something, in our cases, on average of 7 years, and it isn't really what they want it to happen, they're looking to go and do something else. It hasn't really filled their cup, and so um, and for that reason, like obviously founders transition, but the founder sticking on and sticking on with the brand for multiple years is not a part of the Hedgehog strategy. Now we know other platforms that it is, but it isn't in our case, mostly because of our buy side thesis. We integrate portions of the team, but again, we also lean out the teams, and because we're trying to drive that EBITDA. But no, we would almost always have some team members come over.
How active is Hedgehog right now in terms of making actually buying companies? It seems like this is you're in a pretty good position at this point in time, considering like the market condition in consumer. Uh, but what's like the ideal number of brands that you want to acquire, and how are you thinking about it as well in 2024?
Yeah, we would have bought 3 brands this year. I think next year we'd probably imagine something similar. We don't have a specific mandate of we need to buy X brands each year. I think we see more brands than ever at the moment, but we're trying to be really cautious. Just the way that the overall market is, we don't want to get into a situation where 2024, an election year, there's softness in the market, and then we're holding a bunch of brands that are really challenged. So it's we're seeing more brands than ever, but we're still being very, very cautious.
What's one book that's inspired you personally, and one book that's inspired you professionally?
Yeah, I would say like so. I've read probably 3 books that were situational in different points of my life. When I was in college, I wanted to be an investment banker. I read Richard Branson's "Losing My Virginity," which was just like his autobiography about being a maverick, being a brand builder, having an affinity for consumer products and consumer experiences. That really changed my life, and kind of set me down a path of being a consumer brand entrepreneur. Then in my probably late 20s, I read the Warren Buffett biography Snowball, which again kind of introduced me to a portfolio strategy, a probably slightly longer term view versus the venture short duration view, which was really transformative. And then more recently, and this one is much more about life, a book by Arthur Brooks called Build a Life You Want, which is much more just about, he's a Harvard professor, done a lot of psychology and biology research work around happiness, which is going to just, inform, kind of how I want to, the life I want to lead.
That's awesome. Thanks for sharing these three. We've had on a couple past guests to talk about lose my virginity, but I don't think the other two we've actually had others mention. So that's great. Thank you, Fan. Fan, this is a lot of fun. Thank you so much for your time.
Yeah, absolutely, Mike. Really enjoyed the podcast. I think it's really great kind of what you're doing for the community, and excited to share our story.
That's so kind. I love your Twitter posts. I love your breakdown of kind of different fundraisers and kind of acquisitions. So really appreciate also all that you share on the media side.
Yeah, thanks so much, Mike.
And there you have it. Fan, thanks so much again for coming on the podcast. Really enjoyed talking with you. If you enjoyed this episode and you want to stay in the loop, I highly recommend subscribing to my newsletter at theconsumervc.com, where you'll receive all the new updates when it comes to consumer fundraising from the past week. You'll also receive new episodes straight to your inbox. If you're subscribing on YouTube or wherever you're listening to this podcast, I'll also hit the subscribe button. Thank you for listening.